Hi, friends. This is Lisa Marie Contaldi with Intero Real Estate. Rates, rates, rates. Uncertainty or certainty. This is a discussion about mortgage rates and their volatility and its basic effects on the current housing market. The weather here in Austin has been hot, cold, hot, cold. And this reminds me of our interest rate scenario up, down, up, down. Everybody's talking about rates today as they cool or fuel the market. Let me say this is going to be a good year. Buyers and sellers who have been on the fence, they're going to come into the market. But the market is interest rate sensitive and very dependent. Yes, it is. Homes are less affordable than they used to be, but home prices are more affordable, but the purchasing power is low if you're not totally cashing out on investments or home equity. It just depends upon what kind of buyer you are. I can reassure you that down the road, we will see interest rates and homes overall be more affordable when we hit the 5% range. The big question is when. What are rates doing? Well, compared to 2 weeks ago, they're up. Compared to last October, they're down by a percentage point. It's all about perspective. Today's 30-year fixed rate from Mortgage Bankers Association is about 6.78%. So even the slightest uptick or downtick in rates will help or hurt our market as it is very volatile. The first thing I would ask you if you're a buyer at any stage of life who needs to finance a home is, can you afford the payment? Meaning, does it give you the lifestyle you're comfortable with? Enough said. Let's talk more about bond prices, specifically the U.S. 10-year Treasury note rate. Mortgage bond prices determine home loan rates. According to the North American Journal of Economics and Finance in September 2023, an article titled Uncertainty about Interest Rates and the Real Economy, the U.S. Treasury market is an indicator of where the economy is heading. It's very influential. Here's what you need to know. If the amount of U.S. debt is high, over $34 trillion, how much debt does the Treasury have to sell to fund the government for the first quarter? About $816 billion, according to USTreasury.gov. The Treasury Department sells bonds to fund the government. I want to clarify, the Fed does not set mortgage rates. Inflation and U.S. Treasuries influence rates. The 10-year U.S. Treasury bond yield serves as a baseline for fixed mortgage rates, which provides financing to the housing industry. So, to encourage investors to buy U.S. Treasury bonds to fund our debt, it has to issue higher rates. And currently, it's over 4%. Until the rate on the 10-year Treasury note goes below 4%, most housing experts do not predict lower interest rates, lower mortgage rates. Again, please note, it is an election year. And although historically, during election years, interest rates have not been affected, economic uncertainty most certainly has. Again, quoting the North American Journal of Economics article, interest rate uncertainty can be indicative of the future evolution of the real economy activity, because this type of uncertainty can prompt changes in the cost of hedging one's risk regarding interest rates. In other words, if you are looking at the overall economy and you don't feel comfortable, you're not willing to make big moves. What do other economists say about interest rates? Dean Baker, the senior economic economist at the Center of Economic Research, said it also appears that mortgage rates are falling again a few weeks ago, right? But we will soon see rates below 6%. So if you're a buyer now and you see uncertainty in the economy, does that make you want to buy or sell? If you have a home and you need to sell that home in order to get another, here's my take on it. It depends on which buyer archetype you are. The question is, do you want to be ahead of or behind the curve? Be poised to take action. Get pre approved today fully and start shopping. In our next podcast, we will talk about the 10 buyer archetypes in today's market. Have a great week.